In today's video, we're diving into something every investor needs to hear right now. Tom Lee, one of the most well-known and closely followed market strategists, just dropped some bold insights on CNBC's Squawk on the Street. And according to him, this AI-driven market is still way too cheap to ignore. That's right, he says Nvidia, now the most valuable company in the entire S&P 500, absolutely deserves that top spot. In his words, it makes a lot of sense. In this interview, Tom Lee breaks down why Nvidia, and other AI-related stocks, could still have plenty of upside ahead, despite all the noise about valuations and market concentration. I'm about to play you this clip where he lays it all out, and after we watch it together, I'll share my own reaction and analysis of what he said, and what it really means for your portfolio going forward. Then, to wrap things up, I'll be breaking down 2 high-powered growth stocks that you can buy right now, especially if you're looking to capitalize on this AI boom, just like the big players are doing. If you only watch one investing video today, make sure it's this one, and stick around until the end because you won't want to miss my stock picks. And hey, if you get value from this video, smash that like button. Let's see if we can hit 1,000 likes on this one. Don't forget to subscribe and turn on notifications so you never miss the next big investing update. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Alright, let's dive in and hear what Tom Lee has to say.
Joining us now here at Post 9 is Tom Lee, Fundstrat Global Advisors, Head of Research, and Fundstrat Capital, Chief Investment Officer, also a CNBC contributor. Good to have you, Tom. So how are you, if we could just take a step back, how are you thinking about the whole NVIDIA phenomenon at $4 trillion against this backdrop of just broad AI demand, as well as just appetite in the market for kind of this risk-on sentiment as made evident by the Bitcoin move?
Well, to me, NVIDIA being the most valuable company in the S&P makes a lot of sense. I mean, that's scarce. I mean, how many NVIDIAs are there in the world, right? There's 50,000 stocks. There's one NVIDIA. And so it is scarcer than, like, Da Vinci. So I do think the multiple at around 30 times is actually not that extended, given how important they are to the AI ecosystem. So I think there's earnings visibility and then there's multiple expansion potential.
Multiple expansion potential for NVIDIA as well as just the broader NASDAQ from here. Do you think there are significant catalysts to the upside?
Yeah, I think to the extent that there's companies that are producing durable, sustained earnings growth, whether it's the Palantirs or the NVIDIAs or the Teslas of the world, they do deserve higher multiples. And you know, something that we've been writing about is how this market endured 6 essentially black swans in the last 5 years, thrived in terms of earnings. Normally, we would assign a higher market multiple to that. And believe it or not, the mean S&P PE, so if you do the S&P equal weight, was 17.9 on the eve of COVID. It's about 0.7 turns lower today. We're like at a 16 mean multiple, meaning the market got cheaper after 6 black swans. I almost think we should be expanding that PE.
There are some complaints this morning about, again, market concentration, right? When you got the top 10, is it 40% of market cap? Something. NVIDIA alone's almost 8%.
That's right. But then again, these exact companies are a huge share of earnings growth, you know? So I think that the S&P is benefiting from the fact that it is sitting at the center of AI, which is a huge global driver of CapEx spending. It's going to help S&P earnings. And then the other piece is, of course, financial innovation, which is taking place. I mean, Circle and the cryptos have shown that that's another piece where there's a lot of earnings growth. And again, that's a growing share of the S&P.
Tom, I wanted to spend a minute, if I can, talking about a company called Bitmine Emergent Technologies. You recently became chairman of that company, correct?
Yes, that's right.
I want to ask you a few things and just see if I got this right. Now, the stock I mentioned, it hit 161 very recently. It's been very volatile. The company did a PIPE, 250 million, I think sold as many as 55 million shares at, I guess, 450 or so a share, correct?
Yes.
Those shares have not yet been registered. Is that correct?
That's right.
Okay.
They will eventually be registered.
Okay. I want to make that point because, you know, when you look at FactSet, you got 6 million shares out. It's a 300 million or so market cap, but that's not the case. This has got 61 million shares outstanding, at least, and a market value, therefore, even at 55, that is many billions of dollars, correct?
That math works.
Okay.
I'm following your math.
You're going out, you're spending the $250 million to buy Ether, is my understanding, or maybe a little Bitcoin, but mostly Ether.
Yes, it is for Ethereum.
Okay, and so this trades at a huge multiple to the amount of Ether you conceivably could buy with the money that was raised in the pipe.
Yes, I mean, in the press release, there's a sort of a discussion about Ethereum treasury strategies, and to us, there is like a logic to what these companies are trying to do, because one, they're actually going to be using whatever relative premium exists to actually use capital markets to grow their Ethereum holdings.
Okay, so meaning what, you can add value to the overall holdings that you have through things that can be done in the Ethereum ecosystem.
Yes, as well as like taking advantage of the premium that exists in capital markets activities.
I see.
And of course, I think that there is really a rediscovery of Ethereum that's taking place, because Ethereum itself is one of the best performing crypto assets. It's up, annualizing,
right.
It's really taken off recently because the stable coin is the ChatGPT moment for crypto. Circle has blown the doors open. There's a lot of interest now on Wall Street getting involved with Ethereum and building stable coins. That's 30% of Ethereum's network usage today.
Right. But it is a technology in addition to, it's not just like Bitcoin, which is sort of seen as
that's right.
almost a gold. It is a technology. It could lose market share as well, couldn't it, to the likes of Solana?
That's true, but when you see like the JP Morgan stablecoin, it's being built on Ethereum.
Right.
Robinhood is building their tokenizing business on Ethereum. So as what they call a layer one, Ethereum is like the preferred choice for Wall Street. It already is more than 60% of all the tokenized real world assets, and I think that share is growing. If stablecoins grow to over $2 trillion, as Treasury Secretary Bessent predicts, that's an exponential usage of Ethereum and the Ethereum token. So It's really positive for Ethereum. And incidentally, the Circle trades at around 100 times EBITDA.
Understood. But I just want to make the point to people who are buying the stock, because you have a big following, a retail following as well, that they are paying many multiples of the value of the Ether you're buying at this point. My understanding as well is you have an at-the-market share program also. Isn't that correct?
Yes. There is an S3 that has been filed. I'm not really able to comment on, what I would see as the valuation of the company, but
well, I can do it right now based on the number of shares that are outstanding, which is something like 60 plus million, and then I don't know what you're selling under the ATM, and I multiply it by 55, and I get a number that's above $3.5 billion.
I believe your math is correct.
Okay.
I would trust your math.
All right, so that's 11, 12 times the value of the Ether that you have. I'm just doing quick math here.
Yeah, or it depends on really how much is being accomplished through all these combination of activities as well.
Okay. All right.
So first off, Tom Lee kicks things off by addressing one of the hottest topics in the market today, NVIDIA. And listen to this. He says that NVIDIA being the most valuable company in the S&P 500 actually makes sense. Why? Because of its absolute scarcity. He makes a fascinating point here. He compares NVIDIA to a Da Vinci painting, suggesting there's simply nothing else like it. Out of the roughly 50,000 publicly traded companies worldwide, there's only one NVIDIA. And because it's the heart of the entire AI ecosystem, Lee believes the company deserves not only its current valuation, but potentially even higher valuations in the future. Now here's where it gets even more interesting. He talks about the market's earnings visibility. In his view, NVIDIA's earnings are solid, and its valuation isn't actually as stretched as many think. With a price-to-earnings multiple around 30 times, he believes it's reasonable given NVIDIA's central role in AI innovation. And it's not just NVIDIA. Lee also mentions companies like Palantir and Tesla. He argues that these firms, which are producing consistent durable earnings growth, deserve higher multiples as well. He points out that this isn't just about hype, it's about rewarding companies that have shown they can thrive under pressure. Here's a key point he makes that I think every investor needs to hear. Over the last 5 years, the market has survived not just 1 or 2, but 6 major black swan events. Think about that. COVID, the supply chain crisis, inflation surges, rapid Fed rate hikes, geopolitical shocks. This market has been through it all, and yet, earnings have continued to grow. What really stood out to me was his comment about market valuations. He says that despite surviving all those crises, the market today actually trades at a lower average multiple than it did right before COVID. Specifically, he says the SP's mean price-to-earnings ratio today is around 16, compared to nearly 18 pre-COVID. In his words, the market actually got cheaper after facing all those crises. That's pretty incredible if you think about it. Now, some critics argue that the market is too concentrated in just a handful of tech giants, Nvidia, Apple, Microsoft, and so on. Lee's take? He admits that yes, these companies represent a huge share of the market cap, around 40% of the S&P 500, but he says they also represent a huge share of the earnings growth. In other words, they're not just expensive for no reason, they're driving actual profits and innovation, especially in areas like AI and digital finance. Next, the conversation shifts to another fascinating topic: Bitmain emerging technologies. Tom Lee recently became chairman of this company, and the discussion here is very technical but extremely important for anyone interested in crypto-related stocks. Bitmain stock has been on a wild ride lately, soaring as high as $161 per share. However, what many investors don't realize, and Lee makes this clear, is that the company did a $250 million PIPE deal, private investment in public equity, issuing about 55 million shares at around $4.50 per share. Those shares haven't been registered yet, meaning they aren't fully trading on the open market. This is crucial because it means the company's real market cap is much larger than it appears on the surface. Lee confirms that once you account for all outstanding shares, Bitmain's market cap could easily exceed $5 billion, a figure many retail investors may not fully grasp. Now here's where it gets really intriguing. Bitmain is taking the capital it raised and using it to buy Ethereum, with a smaller portion allocated to Bitcoin. Their strategy isn't just about buying crypto and sitting on it, they're aiming to use Ethereum in ways that could grow its value further. Essentially, they're leveraging the capital markets to expand their Ethereum holdings and participate in Ethereum's growing ecosystem. Lee emphasizes that Ethereum is rapidly gaining traction, especially as Wall Street embraces stablecoins and tokenization. Major players like JP Morgan and Robinhood are already building financial products directly on the Ethereum network, which Lee calls the preferred choice for real-world asset tokenization. He points out that 60% of all tokenized real-world assets already run on Ethereum, and that number is growing fast. If stablecoins do expand to a multi-trillion-dollar market, as some predict, Ethereum usage would surge dramatically, which would naturally benefit Ethereum's value and its ecosystem. Now, I really want to pause here because this part is critical for investors. The host makes an excellent point, reminding viewers that while the company may be leveraging Ethereum's potential, its stock is currently trading at many multiples of the actual Ether it holds. In fact, based on the numbers discussed in the interview, the company's market value could be over 10 times the value of its crypto holdings. Tom Lee doesn't dispute this, but he explains that the company is also looking to use this capital to engage in activities within the Ethereum ecosystem that could potentially grow its overall value beyond just the crypto it holds today. Bottom line, Lee is suggesting that both Nvidia and Ethereum-linked plays are positioned for major growth, but he also makes it clear that investors need to understand the risks. Stocks like Bitmain can trade at massive premiums because of their growth strategies and speculative appeal, but that also means they can be extremely volatile. My take? Tom Lee's message here is pretty clear. He believes we're still in the early innings of both the AI revolution and Ethereum's rise in the financial system. He's bullish on companies at the center of these movements, and he's making a strong case that many investors are underestimating just how transformative these technologies will be. But, and this is key, he's also saying you need to be very careful. Companies trading at big premiums might deliver huge gains if they succeed, but they could also drop sharply if their strategies don't play out as planned. So as always, do your homework. If you're thinking about investing in any of the companies mentioned here, make sure you fully understand their business models, their valuations, and their risks. That wraps up my breakdown on this Tom Lee interview. Now, I'd love to hear your thoughts. Do you agree with Tom Lee's bullish stance on Nvidia, Ethereum, and the broader market? Drop your comments below, and let's get a conversation going. And don't forget, if you found this video helpful, give it a thumbs up, share it with others, and subscribe for more deep dive analysis like this. Alright, let's dive right in and explore the two high-powered growth stocks to buy now. First up on our list, we're going to be talking about Nebius Group, ticker symbol NBIS. This is a company that might not be a household name just yet, but trust me, they're playing a pivotal role behind the scenes in one of the most transformative technological shifts of our time. A company quietly but powerfully building the very foundation for the artificial intelligence revolution that's rapidly reshaping our world. They're not creating the AI models themselves, but they're providing the essential infrastructure that makes it all possible. Nebius is strategically positioned at the forefront of AI infrastructure, operating massive hyperscale GPU clusters for enterprise clients who are increasingly desperate for access to immense amounts of AI compute power. These aren't your average data centers. We're talking about facilities packed with the most advanced processing technology available. Think about it. Every AI tool you use, every groundbreaking new large language model that hits the market, needs an absolutely astronomical amount of processing power to function. And that power is primarily supplied by high-end GPUs, with NVIDIA leading the charge in this space. These GPUs are the workhorses of the AI revolution, crunching massive datasets and enabling complex algorithms to learn and evolve. The demand for this kind of compute power is not just growing, it's exploding at an unprecedented rate, doubling every 6 months according to some estimates. And the reality is, there's a significant global shortage of these critical resources. This shortage is creating a bottleneck in AI development, making companies like Nebius even more valuable. In a sense, Nebius is the picks and shovels supplier of the AI gold rush, and they are definitely not just a small player in this rapidly expanding market. They're positioning themselves to be a dominant force. To give you an idea of their scale, their Kansas City facility alone is currently being built to house a staggering 35,000 of NVIDIA's most powerful, cutting-edge GPUs, a direct and decisive response to the overwhelming and ever-increasing market demand for AI compute. And the numbers speak for themselves. In Q1 2025, Nebius reported truly impressive revenue growth of 385% year-over-year. That's the kind of hypergrowth that you only see once in a generation, a trajectory that puts them in a league of their own. Looking ahead, their annual recurring revenue is projected to hit an astounding $750 million to $1 billion by the end of 2025. And this isn't just speculative. It's underpinned by customers signing substantial long-term contracts, securing their revenue stream for years to come. This predictable and rapidly growing revenue stream is exactly what investors are looking for, providing a sense of stability and confidence in the company's future prospects. So, the big question, can they actually afford to fund this massive expansion and keep up with the breakneck pace of growth? Well, Nebius is currently sitting on a very comfortable $1.44 billion in cash reserves, and they're managing their debt responsibly, which means they have plenty of fuel in the tank to power their rocket ship even higher. And here's the ultimate seal of approval that really sets them apart. They've secured direct investment from NVIDIA themselves, as well as Jeff Bezos' personal investment firm, Bezos Expeditions. That's right, NVIDIA, the leading chipmaker in the AI space, and Bezos, the visionary mind behind Amazon Web Services, the dominant cloud computing platform, both clearly see Nebius as a long-term winner in this high-stakes game. Their investment is a strong vote of confidence in Nebius's strategy and execution. And when you look at their position in the market, Nebius's competitive moat becomes very clear. They have first-mover scale advantage and privileged access to NVIDIA's very latest and most advanced chips, including the highly anticipated Blackwell architecture. This means they're essentially at the front of the line when it comes to acquiring next-generation GPUs, which in turn gives their clients a significant performance edge over the competition. Now let's talk about valuation. At first glance, Nebius trades at over 70 times trailing sales, which on the surface sounds undeniably steep. However, it's crucial to remember that you simply can't accurately value a hyper-growth company like this based solely on last year's numbers. You need to look ahead. When you use forward estimates, the price-to-sales ratio comes down significantly, to under 25 for 2025. And even this premium is arguably justified when you consider their revolutionary role in the AI landscape and their immense future potential. The surging demand for AI compute is without a doubt the single biggest tailwind in the entire tech sector right now, representing a fundamental and far-reaching shift in the global economy as we know it. Nebius isn't just passively participating in this transformation, they're actively enabling this shift by providing the critical infrastructure that powers it. And for investors who recognize this opportunity and get in now, the potential upside could be truly enormous. This is about more than just short-term gains. It's about investing in the fundamental infrastructure that will power decades of innovation and technological advancement, a pure-play investment opportunity directly tied to the explosive growth of the AI revolution. Despite having a market cap of around $11 billion and posting a net loss of roughly $644 million in 2024, the company is showing some remarkable progress. Revenue for the year came in at about $117.5 million, but what's really turning heads is their recent growth. In the first quarter of 2025 alone, Nebius reported an incredible 385% increase in sales compared to the same period last year, hitting $55.3 million in revenue. That's a massive surge, and speaks to the growing demand for AI infrastructure solutions, which are becoming a crucial part of the broader tech landscape right now. What's also worth noting here is the company's focus on sustainability. In their latest sustainability report, Nebius highlighted their long-term strategy of integrating sustainable practices into their operations, something that's becoming increasingly important for investors who are looking at long-term value, especially in the tech and AI sectors. Analyst sentiment around Nebius remains optimistic. Many still view the stock as undervalued despite its recent price movements. Analysts expect even more upside potential as the company's aggressive expansion in the AI infrastructure space continues to unfold. Of course, it's not all smooth sailing, there's still volatility around the stock, but the combination of rapid growth, sustainability efforts, and analyst backing suggests this is definitely a company to keep on the radar. To quickly recap, Nebius Group is demonstrating insane revenue growth. They have a massive addressable market with virtually unlimited potential, a strong and healthy balance sheet, and they've received strategic validation from industry leaders like NVIDIA and Bezos. Yes, the valuation might initially seem high, but when you truly understand the sheer scale and potential of the AI revolution, it starts to look not only reasonable, but potentially even undervalued. This is a company that is actively building the future, and it's definitely one that you need to have on your investment radar. Now that's a look into the digital world and the AI revolution. But there's another revolution happening right now in what was once considered the final frontier space, which seamlessly brings me to our second company that we're going to be discussing today. But before we get there, if you're finding this deep dive into these companies insightful and enjoyable, please take a moment to hit that like button down below. It really helps us out. Alright, with that said, let's move on and explore the next exciting opportunity. Our second company, poised to capitalize on the burgeoning space economy, is Rocket Lab. You can find them on the NASDAQ under the ticker symbol RKLB. Keep an eye on that ticker as we delve deeper into their operations and future prospects. Rocket Lab is taking us from Earth's data centers, where information is processed and stored, to the vast, unexplored vacuum of space, where new frontiers are constantly being pushed. They are bridging the gap between our terrestrial needs and the boundless opportunities beyond our atmosphere. You might know Rocket Lab primarily for its Electron rocket, a nimble and reliable launch vehicle that has become a workhorse for small satellite deployment. But the real story, the truly compelling narrative, is their ongoing transformation. It's a story of strategic vision and adaptability in a rapidly evolving industry. Rocket Lab is evolving into a diversified end-to-end space infrastructure company, offering a comprehensive suite of services that extend far beyond just launching rockets. They are building the very foundation upon which the new space economy will be built. They now design, build, and manage entire satellites, tailoring them to specific mission requirements and customer needs. This includes everything from the initial concept to on-orbit operations. They also manufacture and supply critical satellite components, providing essential building blocks for other space companies and government agencies. This vertical integration gives them greater control over their supply chain and allows them to capture more value. Rocket Lab doesn't just launch them as a service for other companies, they are becoming increasingly involved in the entire life cycle of a space mission, from conception to completion. This strategic shift is critical, marking a significant turning point in the company's trajectory and positioning them for long-term success. Because the real money, the sustainable and high-growth revenue, is in space systems and infrastructure, the essential components and services that underpin the entire space economy. This includes satellite buses, the foundational structure that houses all the critical components of a satellite, and star trackers, sophisticated navigation instruments that allow satellites to precisely determine their orientation in space, as well as reaction wheels, which are used for precise attitude control, allowing satellites to point accurately at their targets. Not to mention solar panels, which provide the essential power needed to keep satellites functioning in the harsh environment of space, and the complex software that controls every aspect of a satellite's operation, from communication to data processing. Looking at their recent financial performance in Q1 2025, Rocket Lab's revenue was up a significant 32% year over year, demonstrating strong growth momentum, and importantly, with over half of their revenue now coming from their higher-margin spacecraft systems division. This shift is not just about growth, it's about improving profitability and building a more sustainable business. This diversification makes Rocket Lab a more resilient and profitable company, better positioned to weather economic uncertainties and capitalize on emerging opportunities in the space sector. They are generating revenue across the entire life cycle of a space mission, from initial design and manufacturing to launch, on-orbit operations, and even decommissioning. This comprehensive approach creates multiple revenue streams and strengthens their customer relationships. The U.S. government, the world's largest and most demanding space customer representing a significant portion of the overall market, is increasingly backing Rocket Lab, recognizing their capabilities and strategic importance to national security and space exploration. They were selected for the highly competitive $5.6 billion National Security Space Launch Phase 3 Lane 1 program, a testament to their technological prowess and reliability. This is a huge deal, solidifying their position as a key player in the national security space arena. Rocket Lab is now a participant in multiple billion-dollar defense frameworks, giving them access to a steady stream of government funding and long-term contracts. This includes participation in the MATCH-TB hypersonic testing program, pushing the boundaries of aerospace technology, and contributing to national defense capabilities. Becoming a trusted provider for the Department of Defense is a strategic imperative for any space company seeking long-term stability and growth. Securing that trust is a golden ticket, opening doors to lucrative contracts and long-term partnerships. This translates to stable, long-term revenue streams that are largely insulated from the volatility of commercial market swings, providing a solid foundation for future growth. The space industry inherently has high barriers to entry, requiring significant capital investment, specialized expertise, and a proven track record of success. And Rocket Lab has definitively earned its place as a leader in this challenging and competitive landscape. They've done this with proven performance and a demonstrated commitment to reliability, consistently delivering successful launches and providing dependable space solutions. The number of satellites needing to reach orbit is skyrocketing, driven by the increasing demand for communication, Earth observation, and scientific research. But the number of reliable launch providers capable of meeting this growing demand remains relatively few, creating a significant bottleneck in the space industry. This fundamental supply-demand imbalance gives Rocket Lab significant pricing power, allowing them to command premium prices for their launch services and maximize their profitability. This creates a clear runway for continued growth and expansion, positioning Rocket Lab for sustained success in the years to come. Now let's talk about valuation, a critical aspect of any investment decision. The company currently has a market cap of about $19.77 billion, with 2024 revenue of $436 million. Like many high-growth companies, they're still operating at a net loss, about $190 million, but that hasn't stopped their stock from soaring. Rocket Lab's shares surged by over 33% in June and have continued climbing in July. In fact, the stock recently closed at $38.88, up 9% in just the last session, showing some very strong bullish momentum. One of the key catalysts behind this move is a major contract awarded to Bollinger Shipyards to upgrade Rocket Lab's ocean landing platform for its Neutron reusable rocket. This highlights Rocket Lab's ongoing push toward innovation and its clear commitment to scaling up operations in the competitive space launch market. Financially, Rocket Lab reported $122.6 million in revenue in the first quarter of fiscal 2025, marking a 32% year-over-year increase. Their backlog now exceeds $1 billion, specifically $1.067 billion, which signals strong demand and a healthy pipeline of future projects. And it doesn't stop there. Rocket Lab has been making significant moves in the U.S. space defense sector, recently securing a massive $515 million Department of Defense contract. This deal not only boosts their financials but also positions the company as a serious player in the defense space, enhancing its credibility in a sector where trust and performance are paramount. Operationally, Rocket Lab has maintained a 100% mission success rate in 2025, a critical metric that strengthens investor confidence and underlines their reliability as a launch service provider. Currently, Rocket Lab trades at around 41 times trailing sales, a metric that reflects investor expectations for future growth. That's certainly not cheap, indicating that the market has already priced in a significant amount of future potential. But remember, you're not just paying for a launch company. You're investing in a higher-margin, diversified space infrastructure powerhouse with multiple revenue streams and significant growth opportunities. You're not just buying a launch business that is subject to the cyclical nature of the launch market. You're buying into their rapidly growing space systems division, which offers higher margins and greater stability. And you're also investing in their increasingly important status as a prime government contractor, securing lucrative and long-term contracts. Looking ahead, their upcoming Neutron rocket will open even bigger markets, expanding their reach and capabilities in the space industry. This includes opportunities like mega constellation deployment, enabling the launch of hundreds or even thousands of satellites at once, and deep space missions, pushing the boundaries of scientific exploration. Industry analysts project that satellite launches are projected to increase fivefold by 2030, a staggering growth rate that underscores the immense potential of the space economy. This represents a tidal wave of demand that Rocket Lab is strategically positioned to capture, solidifying their position as a leading player in the space industry. They're playing a key role in enabling both the commercialization and the increasing militarization of space, two powerful and transformative trends that are reshaping our world. These are two of the biggest trends of our time, and Rocket Lab is at the forefront of both. Ultimately, investing in Rocket Lab is a bet that the space economy is still in its early stages, with enormous potential for future growth and innovation. It's a belief that the demand for space access and the need for robust space infrastructure will continue to grow exponentially in the coming years. Rocket Lab is no longer just a rocket company focused solely on launch services. They have evolved into something much bigger and more strategic. It's a foundational piece of the space ecosystem, providing essential infrastructure and services that enable other companies and government agencies to achieve their space-related goals. So, to summarize the key takeaways about Rocket Lab is successfully transitioning to a higher-margin business model, shifting its focus from launch services to space systems and infrastructure. They are demonstrating strong revenue growth, driven by increasing demand for their products and services. They are securing lucrative government contracts, providing a stable and predictable revenue stream, and they are leading an industry characterized by a massive supply-demand imbalance, giving them significant pricing power and growth opportunities. While the valuation is forward-looking and reflects high expectations, it's pricing in a future where Rocket Lab is a dominant force in the rapidly expanding space economy, a future that seems increasingly likely. It's an incredible story of innovation, strategic vision, and relentless execution. And it's another company that deserves your attention as you consider investment opportunities in the exciting and rapidly evolving space sector. There you have it, a glimpse into the future being built right now. We've explored the convergence of innovation and opportunity, highlighting companies that are not just participating in technological advancements, but actively shaping them. Two companies at the epicenter, driving innovation and pushing boundaries of the biggest technological revolutions of our lifetime. Revolutions that promise to reshape industries, redefine possibilities, and ultimately transform the way we live and interact with the world around us. Nebius Group is building the digital bedrock, the very foundation upon which the next generation of technological marvels will be built. For the AI boom, providing the infrastructure and resources necessary to fuel the exponential growth of artificial intelligence and machine learning. While Rocket Lab is becoming the foundational workshop, the engine room, if you will, for the new space economy. A new era of space exploration, commercialization, and opportunity that is rapidly unfolding before our eyes. Both have high valuations, reflecting the market's recognition of their potential and the significant role they are poised to play. But their growth and massive tailwinds, the powerful forces propelling them forward, make them companies defining the future. Companies that are not just adapting to change but actively creating it. These are opportunities that can truly change a portfolio, offering the potential for significant returns and long-term growth. If you look beyond the trailing numbers, beyond the historical data, and see the bigger picture. Understand the underlying trends, the disruptive technologies, and the transformative potential that these companies possess. The world is changing fast, at an unprecedented pace, and the biggest gains will go to those, the astute investors who identify the enablers of that change early, who recognize the companies that are driving innovation and shaping the future before the rest of the market catches on. As always, do your own research, conduct thorough due diligence, but these are two names you can't ignore. Keep them on your radar, analyze their potential, and consider the role they might play in your investment strategy. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. If you got value from this video, hit that like button, show your support, share your thoughts in the comments, let's start a conversation, and subscribe for more investing updates. Stay informed, stay ahead of the curve. Thanks for watching, I appreciate your time and attention, and I'll see you in the next one.